I'm Scott Olson, reporter at the Indianapolis Business Journal, here with John Augustine, Chief Investment Strategist at Fifth Third Bank. John spoke this morning at IBJ's annual economic forecast and talked about the probability of an economic recovery in 2010. John, what are some of the indicators that you see that might point to a recovery next year?
Yeah, a couple things, Scott. First off, we haven't seen job growth yet, but job losses are not as bad as they were. So in other words, corporations don't seem to be laying off as many people. There's starting to be stabilization there. That's good. Nobody likes to see 10% unemployment, but layoffs have kind of stopped at this point in time. So that's number one. Number two, we're starting to see corporations spend again, as an example. They're starting to invest in capital equipment. They're starting to buy other companies. That's a good sign. Number three, we're seeing, depending on what part of the country you're in, the housing market try to stabilize. Prices and activity are trying to stabilize. Then number four, we are seeing consumers come back into the economy. Not in ways coming out of past recessions, much more frugally, but they are coming back into the economy. Those are the things we're pointing at.
Okay, and you talked a little bit about some of the challenges that might prevent a recovery or maybe delay it. Can you talk a little bit about those?
Yeah, I mean, if we see, for instance, commodity prices spike like we saw last year, if we see interest rates spike and take mortgage rates up too high, if we see a reversal in those unemployment numbers, for instance, if layoffs start to come back into the economy. So really the basic things, basic building blocks, now so far so good, we're not seeing risks there. But on the near-term basis, through the winter, those are what we're really going to be looking at.
Okay. And finally, public companies are beginning to release corporate earnings for the third quarter this week. What do you expect there?
Well, so far so good. The ones we've seen come out are doing what's called better than expected earnings. So remember, there's a whole stock analyst community whose job it is to try to figure out what those earnings are going to be. They come up with consensus numbers. So far, those corporations are doing better than those consensus numbers. The expectations are pretty high now moving forward. So now we need to see how productive these corporations made themselves during this Great Recession. And again, as mentioned, so far so good. We think the earnings power of these companies should be pretty good on the other side. And by the way, that's really what's driving the stock market, is this expectation of this earnings rebound. And all we can say is so far so good.
You talked a little bit about profits could be upwards to 20% or so?
Yeah, I mean, what we're really looking for next year in our business, the investment business, those big public companies we think about, for them to improve profits 20% year over year. Now, a couple things to keep in mind about that. First off, they really went down last year, so you have easy comparisons. Second thing is, on average, think of it this way. Those public companies, on average, usually raise profits about 7% per year. So we're thinking companies, not just us, but analysts, are thinking companies are going to do about 3 times that next year. That's why stock prices are going up.
Great. Thanks a lot, John. I appreciate your time.
Thank you very much. Appreciate it.